Welcome back to another episode of Retire Right. I'm Ryan Wyatt, per usual, joined by Ron Wyatt, Nick Lewandowski, all wealth advisors here at the firm. Nick and Ron specifically are on the investment committee together. Gentlemen, how are you today?
Doing great.
Anything new and exciting, noteworthy?
Just nice weather outside finally.
I have something noteworthy. I golfed with Nick last Sunday, beat him by a few strokes, so better than how it went last year.
Yeah.
Our one client, if you're listening to this, I think we got him in the next rematch round.
Yeah.
The episode, or the focus of the episode today, is talking about debt. More specifically, we're going to talk about how to evaluate debt and make a decision as to whether, because there's good debt and there's bad debt. So when I say evaluate debt, it's more of like, hey, is this logical debt to take on or to keep, or is it better to pay it off? What we'll also do is talk a little bit about some exceptions to the rule. Like, Ron has a specific belief that he's going to go over, but there are exceptions to that. So some people, can carry debt. It's more kind of appropriate for them to carry debt in retirement. We'll talk about what that kind of profile looks like or situation looks like. And then we'll even get into some of the numbers about the further you are out from retirement, what those numbers show in terms of having debt, even though that can be a riskier situation, and increasing your net worth. Gentlemen, anything you want to add in terms of like agenda items that we're going to talk about? So I'm going to start with Nick, just kind of like a very direct question. Would you say that all debt is bad?
No, all debt's not bad. I think what comes to mind when people think of debt is, I'll use your golf thing as a little, I go out after this and I'm like, Ryan burned me on the podcast this morning, so I need to borrow $500,000 to build a golf training facility in my backyard. And I don't have that money to be able to afford that. And so that's not good, right? Borrowing money just to consume where there's no real return other than the psychological benefit of beating you someday is not good. And you see this with people who get into trouble with credit cards and stuff like that. You should never do that. That's just a disaster.
Sounds to me, Nick, like you're not a real competitor.
Hey, he got me, like I said, he got me last year. So this was my revenge.
I'm sorry.
This was my revenge tour.
I digress.
So that kind of thing is really more of a basic budgeting issue, right? Your inflows need to exceed your outflows or at least match them. And though where we start to get into good debt is where you're either using debt for a convenience factor. For example, sometimes we have clients who have a paid off home and they're buying a new home, but there's a timing mismatch between the purchase and the sale and those types of things that it can make sense to.
Like a bridge loan, if you will.
Yeah, bridge loan line of credit can help there. Or the even more common situation is where you have a portfolio of assets that's earning a nice return and you can choose to pay something else off with it, or do I pay cash? Do I sell stock to, and that decision, sometimes it's better to have the debt than sell assets.
Yeah, we'll get into more specifics about.
Gotcha.
Yeah.
Ron, anything you want to add onto that? Is all debt bad kind of topic?
No. I mean, I think that once we look at the numbers, it'll become very obvious.
So let me use that as a segue into how do we evaluate debt and determine if this is good debt or if this is bad debt? And obviously everybody knows, like Nick said, credit card debt could be 18 to 25, maybe even more percent. That's just always going to be bad debt. You would have to be an investment guru to be outpacing that. I mean, it's just by default
more than
debt.
an investment guru. I don't know that there's a record that
you'd have to have the crystal ball that we always talk about where you're predicting the future. So how are you evaluating debt?
The math is extremely simple.
Okay.
You look at, say you're going to buy a car and the interest rate's 7%. And let's just say that you have investments. So you can, if you want to, take money from your account and pay off the car, or you can take the loan. Either way, right? So you have flexibility. And so if your portfolio expected return is 6%, which I'll get into expected returns in a minute, but if it's 6% and the cost of the loan is 7%, I say take the money from your account, pay off the loan, because the loan costs more than the return that you're likely to achieve. On the other hand, if your expected return is 10% and the cost is 6 or 7, it probably behooves you to get a loan and keep the portfolio. So that's simple math. Now, the expected returns, what I would suggest everyone is come to us and we can evaluate that for you, because every year we have a lot of data sources about expected returns, and expected returns are largely dictated by the price you pay for something. If you pay a cheaper price than normal, expected returns tend to be higher. You pay a higher price than normal, expected returns are lower. We have that data, so we can help you out with it.
Right. I think just like looking back at the markets historically, if you looked at the 07 to 09, the financial crisis there, at the bottom of the markets, where again nobody knows where that is.
Right.
But if you look back, where the bottom was, expected returns would have been really good looking forward because the markets were so cheap.
Yeah, if someone asked me in March of 09, should I pay off a 6% car loan from the assets or take a loan, I'd say take the loan, because the expected returns were incredibly good because the market was very cheap.
But if you look more, to kind of recent trends, a lot of the areas of the markets have been pretty expensive.
Especially
so
U.S. large
returns
companies.
have been lower.
Exactly.
So you said something in there, and I think a lot of people describe that as like giving yourself a guaranteed rate of return.
Right.
Could you just I know that concept is simple, but could you just assign some numbers? I think you used like a loan at 6%, or maybe a loan at 7% and expected returns at 6%. So where does the guaranteed rate of return fit in by paying off the debt?
Well, there's not a guaranteed rate of return. The guaranteed savings is, if you have a 6% loan or a 7% loan, if you pay that off, you can think of that as a guaranteed savings or a guaranteed return, right? You don't have to pay 6 or 7%. Okay?
Right.
The portfolio has not a guaranteed return. It's a fluctuating return, but we can kind of assume, we can kind of estimate long term.
Over the long run.
Yeah. But that really comes down to risk. So what will happen is that even if your portfolio expected return is 8 and the loan cost is 7, it might behoove you, financially speaking, to have the debt and keep the portfolio. But if you're very risk adverse, then paying off the loan can still make sense.
Right.
Because what you don't want to have happen is the markets come down and you still have this obligation, and you're losing sleep at night. That doesn't make sense.
It's the more conservative path. You know what the interest rate is on the loan, assuming that it's fixed and it's not variable. By paying that off, you know what you're getting with it. You're taking kind of like the fluctuation risk out of the market.
That's exactly right.
Another thing that I think when it comes to debt that I think is common, I won't say for everybody, I just think it's common, is like the affordability piece. So sometimes people will look at, this is what the monthly payment is for whether it's a house or a car or whatever. So how do you kind of like determine, hey, this is what's affordable based off your situation, kind of taking people away from this is what the monthly payment is?
Well, so the best thing to do is integrate what you're thinking of doing in a financial plan, because it'll give you the answer, okay? Right. It's a trade-off. Like if I buy this, if I buy my second home, if I buy my Bentley or whatever it is, how does it affect your overall plan? Can you afford it? That's the most important issue. The thing to remember is the more your money goes towards assets like homes, cars, the less you have in assets that can produce income and growth.
So let's say the more your money goes towards like your non-financial assets.
Non-financial assets,
like
right.
Real assets.
Yeah.
And
So if you have $20 million, it's not a big deal. But if you have 1 or 2, if you tie up all of your money in these cars and second homes and all that stuff, you just have less money to generate income. So there's a trade-off there. And again, that trade-off, I can't give you all the scenarios now because there's thousands. It's a financial plan.
I mean, it's a retirement income plan. It's like
That's
how much
what it
are
is.
you spending, how much do you save,
Exactly.
all that.
Uh-huh.
Nick, I'll kick it back over to you. So might even test some of your CFP knowledge here. Are there any general rules of thumb that kind of give you a sense of how much debt is too much debt.
This goes back to what Ron was just saying, and I've worked in consumer lending earlier in my career. So there's this rule of thumb you'll read about, 28-36. And 28-36 means 28%, no more than 28% of your income should go toward housing-related debt, like mortgage, essentially.
Yeah.
And no more than 36% should go toward total debt payments of your income.
Of your income.
And that's gross, by the way.
Gross.
That's
yeah.
gross.
Now,
income.
and I want to highlight that because that's from a lender's point of view. Typically, that's where those numbers really derive from. And
Right.
the lender doesn't care whether you have a good financial plan.
No, the lender will tell
cares that
you.
they get their
the
money
lender,
back, right?
every time I've been in the market for a house, the lender's always like, "Oh, you can afford this." I'm like, I'm not spending that much. Like, it's just like they always beef up the numbers.
And the time honored tactic. I mean, I sold loans. When I worked in consumer lending, it was finance, but we weren't fiduciaries. We sold loans, and you sell payment a lot of the time. Because people fixate on what they can afford relative to their paycheck.
I remember when we were moving from Scott Township to Peters Township, and we went over what I could afford, and the agent said, "Oh, you can afford twice as much as you're buying." And I said, "How? We have 3 children. We're saving for college. We're saving for retirement. We're doing all these things with the money." And she says, "Oh, I'm not factoring all that stuff. I'm just talking about, if you wanted to, you could afford it."
They're getting you to be a house rich, cash poor.
Exactly.
Yeah.
So I just looked at her like, you're crazy. So we were very conservative. That's my nature when it comes time to debt and possessions in general.
So that's what I'd say. That those 28-36 rule numbers are absolute maximums.
Yeah.
That you should reasonably or even unreasonably be anywhere near. And the real answer, like Ron said, is you need to do a plan. You really need to look at your situation. You really need to look at your goals, because what you need to save and what you can afford to spend on payments and these lifestyle things that Ron was talking about, it's all moving parts in relation to
exactly. And I mean, and again, it's like if you're like right at retirement or recently retired, that kind of conversation is less appropriate for you. But further out from retirement you are, say you're 50, 51, you think you're going to be working until you're 65, like that really matters, because how much you're saving into your retirement plans and if you do have college funding goals, like the more, like you said, Ron, the more money that you're putting towards these assets that aren't financial assets that are going for you that you can use later on, it is going to impact you. So it's worth keeping an eye on. And I always try to tell people, hey, look, like you said, Nick, it's the max. We want to be below that in terms of the total debt we're servicing.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So Ron, I mentioned earlier when I was kind of teasing what we were going to talk about that you have a belief. The belief is that more often than not, people should head into retirement debt-free.
Yes, and definitely while in retirement, in most situations, it makes sense to have no debt. Correct.
So, 2 things. Could you explain why you have that belief, and then exceptions to the rule?
Yeah, the reason why is that when you're younger, you tend to have a portfolio that's almost you probably should have a portfolio that's almost all stocks. When you're retired, you want to balance a portfolio out. That means stocks and bonds, not just stocks.
Which is going to have a lower rate of return.
Lower rate of return, lower risk. And the reason why you do that is when you're withdrawing money, if the market falls and you're withdrawing money, you're basically forced to sell low. So you want something to preserve value. So in case the stock market's down, you can take it from the other side and not have to sell stocks low. Okay.
Right.
So that's called reverse compounding. Okay.
Right. The debt obligation is not going anywhere. It doesn't care what the markets are doing.
Right.
And so by having to service that in retirement, that's fixed. You're going to have to do that no matter what.
Right.
And so if you have that debt and the markets aren't working, to your benefit, you're essentially going into the portfolio, selling assets when they're at losses. And really, you're taking away, it's before you sell them, it's a loss on paper. But when you sell them at a loss to cover that obligation, that becomes a realized loss.
Yeah, and I just want to.
You can put yourself in a position where you're kind of digging a hole that becomes harder and harder and harder to get yourself out of.
Right. And I just want to emphasize something. We structure retirement portfolios so that we don't have to sell stocks low, okay?
Right.
Because you have assets on the other side. That should, again, retain value. But what happens is, the main thing I want to emphasize is that, pure equity portfolio historically has done, around 10%, maybe going forward it's for the next 10 years or so, maybe it's closer to 8%. And bonds have done like 5.5%. So a balanced portfolio might be in that mid 7.5, mid 7 range, and maybe the next 10 years a little lower. So if your rate of return is expected to be 7, and your mortgage cost is 7 or 6, I believe it behooves you to pay that mortgage off, because you have a guaranteed savings if you pay it off, and you have an unguaranteed return. And can you imagine having a $2 million portfolio, 07 to 09 hits, global financial crisis, right? Even with a balanced portfolio, your portfolio was down probably 30%. And all of a sudden, you have this obligation that's not going away, and your portfolio has dropped. Talk about losing sleep at night.
Yeah.
So pre-retirement, not as important, but post-retirement becomes very important.
Yeah. And, I think of one couple in particular that we work with that I would say is the exception to the case. And their guaranteed income between pensions and Social Security is so high to the point where not only does it meet their debt, it services the debt, but it also covers their spending needs. So their portfolio really isn't being dipped into, so it is able to continue growing. So I would say, just generally speaking, the more guaranteed income that you have in retirement, that tends to be kind of the exception.
Oh yeah. So for example, if you have Social Security and pensions that achieve your spending goals, including the debt, like a mortgage, for example, then you don't have much to worry about, because if the markets go down, you're already covering your cost.
Exactly.
So that's definitely a situation.
Now there could be kind of a case to be made for if it's higher interest rate debt. Say you didn't get the home during COVID, or when it was 2 to 5% mortgage rates, and say you got it at a 6 or 7. There could be a case to be made for, hey, does it make sense to still pay that off?
But right.
The other math still applies.
Right. Yeah. Just in general, what's the cost compared to the expected return, right? The other thing too is, let's just say that you have all your money in an IRA, say $2 million between, say, a couple, and say that it does make sense to pay off the debt, but if you say your mortgage is $300,000. So if you take $300,000 out of your IRA in 1 year, your tax bracket's just going to skyrocket.
You're given what, probably 28% of that to the government, whereas before, maybe based on your spending needs, let's say you were in the
15 or 20 or around
22%
average,
bracket.
Right.
Again, that's a situation very dependent. How your assets are invested. Is it all IRAs? Do you have diversified pool? It all kind of factors into the equation.
Right. So if we run in a situation like that, that's when I turn to Nick and say, hey, Nick, please run me some numbers.
Yeah.
And, how can we pull money out of this IRA to pay off the debt, but do it over multiple years so that we don't bump someone's tax bracket up too high? So that's the solution for that.
Right.
And this comes back to that thing. We talked about this on another podcast when we talked about paying someone, for a specific engagement for planning versus working with someone like us on an ongoing basis. And people have these seemingly simple questions. I just want an answer to whether I should pay my mortgage off or keep the money invested. And you can see from this conversation how quickly that can spiral into a lot of other issues.
It's just there's so many variables that go in, and I think it's like a web almost. It's everything's interconnected. So you have to factor in so many different things to come up with one answer. And really, when you change, if you look at a full-blown retirement income plan, when you change one input to evaluate what you think is a simple question, it's like a trickle effect. That leads into so many other areas of the plan that also need to be reviewed just to make sure that it is sound advice.
Yeah, so we focus on retirement planning, tax planning, and investment management. Paying off debt, all three of those are touched, right? We have to look at all three of those.
Your risk tolerance,
that's related to investment.
The tax liability, you said, if you pull it out of an IRA, skyrocket your taxes. So one more question here, and then we'll close it out, and I'll give this one to Nick. Nick, what would you say the numbers show about carrying debt when further out from retirement? Like how, when you project the numbers, like what does your safety margin or total kind of like worth look like if you get rid of the debt and are able to save more, or carry the debt, save less, but have that higher kind of like risk tolerance?
Yeah, so assuming someone's younger, higher risk tolerance, further out from retirement, and they have a higher expected return on their portfolio, like that 8% conservative estimate for a stock portfolio, or even 10% based on the historical averages, and they have debt at 3, 4, 5%. Every time you run the scenario in a retirement plan, it's going to tell you not to pay the debt off early, and the plan will show a higher value based on the math that we discussed.
In terms of assets,
ending
you can say net worth.
Yeah. Now, the important things I want to highlight there is long time horizon. You're not drawing on the portfolio for your living cash flow during that time period, which those things help mitigate the risk and let you play the market averages over long periods of time. And then, you're in an allocation that is much more aggressive than the typical balanced bond stock portfolio that a retiree would be in.
Yeah, so you have to be willing to accept the risk. So if you're in a predominantly equity-oriented portfolio and you're willing to accept the risk, as Nick said, the ending value can be higher by keeping debt that's at a low to moderate rate.
Yeah, and this doesn't it's not just mortgage. It's not just like purchasing a car. I mean, some people will have goals of, maybe it's buying an RV and traveling, across the country. It's really just like this conversation really applies to like any debt that you either have or are considering taking on. Gentlemen, I appreciate you guys kind of like breaking that topic down today. To our current clients, if you're listening to this and you have questions, you know how to get in touch with us. Please do not hesitate. If you know somebody that, has maybe been talking about this or you think would just benefit from listening, please feel free to spread the word and have them check out the podcast channel. And then if you're a prospective client just tuning in and you kind of like our philosophy on how something is that a lot of people might look as like a simple kind of one-off, very focused question like, is debt good or bad? If you like our philosophy on how that really translates to every single piece of a comprehensive retirement plan, our contact information has been shared a couple different times throughout this episode, especially if you're watching on YouTube. Please don't hesitate to reach out. We're happy to just see if things line up in terms of help you're looking for, the areas of expertise we focus in, and the services that we're providing to our clients. Thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.